What if there was a way to make money without guessing, without gut feelings, and without caring if the market goes up or down? Welcome to the world of quants, people who build money machines out of math. They don't chase hot stocks. They don't follow headlines. They follow the data. And in this video, we're going to show you how they turn chaos into profit. Meet Erin. She doesn't work in a fancy corner office. She works from a laptop, writing code. Instead of following headlines, she's analyzing patterns in energy prices across the last 15 years. She notices something strange. Every time oil drops sharply in spring, natural gas prices tend to jump by summer. Is it luck? No, it's statistics. And Erin is about to make a bet not on one stock, but on a pattern she believes will repeat. Before we dive deeper, let's simplify things. Imagine you're looking at Tesla's stock this year. Some days it jumps, other days it dives. But instead of focusing on the price, you track the percent change from day to day. That's called a return. It's how much something goes up or down. It's the real heartbeat of the market. Prices can mislead, but returns tell the truth. If you pluck daily returns on a graph, it looks random. But then you sort them into a histogram, and suddenly, a familiar shape appears. A bell curve. This curve, known as the normal distribution, shows up everywhere in quantitative finance. It helps us estimate how often small moves happen, and how rare big ones are. And it's not just Tesla. Try Amazon, Netflix, or Coca-Cola. Their return distributions all echo the same curve, centered around zero. That's where the magic begins. This bell curve is defined by two things. The mean, which tells us the average return, how much we expect to gain or lose, and second, the standard deviation, which shows how spread out the returns are, also known as risk. In simple terms, high mean, low risk equals a dream investment. Low mean, high risk equals runaway. But most investments live somewhere in between. And that's where modeling comes in. Now let's level up. Some stocks tend to move together, like Ford and General Motors. If one goes up, the other often follows. This connection is called correlation. When quants analyze a portfolio, they don't just look at individual risks, they look at how everything interacts. To model this, they use something wild, multi-dimensional bell curves. 2 stocks. You've got 2 dimensions. 10 stocks. That's 10 dimensions. You might be working in 500 dimensions. This is where things get crazy. Let's simplify with an example. Imagine 2 airline stocks, Jet Ski and 𝙒𝙗. You believe Jet Ski will outperform 𝙒𝙗 over the next quarter. Not necessarily go up, just do better. So you short 𝙒𝙗 and go long Jet Ski. Even if both fall, as long as Jet Ski drops less, you profit. This is called a pair trade, one of the cleanest quant strategies in the book. It's not about guessing winners. It's about understanding relationships and betting on relative performance. Now think bigger. A portfolio of 500 stocks. How do you decide how much to invest in each one? This is where mean variance optimization comes in. It's a mathematical method that balances risk and return to find the ideal mix of investments. You use 3 key components. 1. A return vector, expected returns for each stock. 2. A covariance matrix, how risks move together. 3. A weight vector, how much money you put into each stock. The goal? Maximize your expected return, while keeping risk at a level you're comfortable with. Depending on your strategy, you might add rules called constraints. Only positive weights. That's a long-only portfolio. Once your constraints are set, software handles the heavy lifting, solving the math and giving you your ideal portfolio in seconds. Once you've got your portfolio weights, you can translate them into real trades. These days, a Python script can automate the entire thing. Buy and sell, all in milliseconds. You don't need a massive team. Just a good model, and clean data. Today's quants aren't stopping at stock prices. They're using machine learning to find hidden trends, alternative data like credit card transactions, satellite images, or foot traffic, even geolocation data to predict how busy a store will be before earnings reports come out. It's not just about faster decisions. It's about smarter ones. Whether they're predicting price movements, balancing a portfolio, or analyzing patterns hidden in satellite images, quants have one job: turn data into predictions and predictions into profit. And that is quantitative finance.